Hi, and welcome back to the Business Career College video series. In this video, we're going to look at what we might refer to as a Section 148, subsection 7, transfer of a life insurance policy. Now, this is really a fairly advanced concept, and there are some, as you might expect, we're referring over to Section 148 of the Income Tax Act, there are some very particular income tax considerations here. And this is something that we cannot do on our own. This is something that, as I'll show you as we go through the video, requires actuarial input. So you're going to have to use a consulting actuary typically to execute this type of transaction. So what we're going to look at here is a transfer of a life insurance policy. Now, you really have to be familiar with the more basic transfers of a life insurance policy from person to person, for example. What we're looking at here is the transfer of a life insurance policy from a shareholder to a corporation. So, first off, I'll go over the sort of scenario that we might try to accomplish this in, and then we'll deal with the detail a little more. So the ideal scenario here is that we have a business owner over here, a shareholder, and our shareholder has a life insurance policy, and then we have a corporation. So the shareholder is obviously a shareholder of the corporation, but at the time we start this transaction, the life policy is personally owned. And the corporation here is flush with cash. So we've got some cash in the corporation. You could potentially execute this same transaction using a promissory note as a substitute for cash and then pay out of future earnings, but then you're creating a liability for the corporation. This is something you would have to recognize. You may not have a problem with that, but it's certainly something that we have to consider. Now, this probably works best where you have a shareholder who has the entire controlling interest, or maybe with their family has the controlling interest in this corporation. It would be tougher to do this in multi-owner corporations, simply because there will be some questions about whether or not somebody is impoverishing the corporation at their own self-interest. So what we're going to do is we take this life insurance policy and we're going to transfer it at what we call fair market value. So the policy can be transferred into the corporation at fair market value, and then the corporation is going to pay for that with its cash. So now we have this transfer of the policy into the corporation pays with cash. So there's obviously some tax consequences here, and the tax consequences are a little complicated and maybe a little bit unexpected.